What if TradingView could automatically find some of the most important Fibonacci levels on your chart, without you having to draw anything yourself? If you've ever struggled to figure out where to place a Fibonacci retracement, or you're not completely sure which swing high and swing low to use, this video is for you. Today, I'll show you how the Auto Fibonacci retracement tool works, how to set it up, how to customize it, and most importantly, how traders use it to identify potential support and resistance zones. We'll also look at a few common mistakes beginners make and how to avoid them. Let's jump in. What is Auto Fibonacci retracement? Before we add the tool to the chart, let's quickly understand what it actually does. A traditional Fibonacci retracement requires you to manually select a major swing high and a major swing low. TradingView then draws a series of levels between those 2 points. Many traders use those levels to identify areas where price might pause, reverse, or continue a trend. The problem is that two traders can often draw completely different Fibonacci retracements on the same chart. And that's where the Auto Fibonacci retracement tool becomes useful. Instead of manually choosing the swing points, the indicator automatically detects them and updates itself as market structure changes. That makes it especially helpful for beginners who are still learning how to identify important price swings. Adding the tool to your chart. Let's start by adding the indicator. Open any chart inside TradingView. In this example, I'll use Bitcoin. At the top of the screen, click Indicators. In the search box, type Auto Fibonacci. You'll see Auto Fib Retracement appear in the results. Click it once, the indicator immediately appears on the chart. At first glance, it might look a little busy. That's completely normal. We're going to clean it up and make it easier to read. Customizing the indicator. Now let's open the settings. Click the gear icon next to the indicator name. One of the first things you'll notice is the colored background between the Fibonacci levels. Some traders like it. Others prefer a cleaner chart. If you want a cleaner look, increase the background transparency until the colored zones disappear. Now you'll be left with only the Fibonacci levels themselves. This makes it easier to focus on price action. Next, decide whether you want the levels extended across the chart. Some traders extend them to the right to project future support and resistance zones. Others keep them shorter to reduce visual clutter. There isn't a right or wrong answer here. Use whichever style helps you read the chart more clearly. You can also choose whether to display the Fibonacci values, the price values, or both. For most beginners, I recommend keeping both visible. This makes it much easier to understand exactly what you're looking at. Which levels matter most? Here's where many beginners get overwhelmed. The tool can display a lot of levels. You don't necessarily need all of them. Many traders focus primarily on a few key areas. The 0.382 level, the 0.5 level, and the 0.618 level. These tend to attract the most attention. That doesn't mean price will always react there, but they are often the first places traders look when searching for potential pullback opportunities. If your chart feels crowded, try hiding some of the less important levels. A cleaner chart often leads to clearer decisions. Let's see it in action. Now let's look at a practical example. Notice how the indicator automatically identifies a recent swing high and swing low. Once those points are selected, all Fibonacci levels are drawn instantly. As price begins to retrace, we can monitor how it behaves around those levels, and this is where things get interesting. Many beginners assume that a Fibonacci level is a buy signal. It isn't. A Fibonacci level is simply an area of interest. Think of it as a location where you want to pay closer attention. Price might reverse there, or it might move straight through it. The level itself doesn't predict the future. It simply helps us identify areas worth watching. Keep this in mind. It's one of the most important concepts in trading. Using the replay tool. Let's make this even more realistic. I'll activate TradingView's replay feature. This allows us to move back in time and watch the indicator update as new candles form. Notice what happens when the market creates a new swing high. The Auto Fibonacci tool automatically recalculates. The entire Fibonacci structure adjusts itself to reflect the latest market conditions. This is one of the biggest advantages of using the automated version. You don't have to constantly redraw your analysis. The tool does the work for you. As new price action develops, the levels remain current. For active traders, this can save a surprising amount of time. How traders actually use these levels. Now let's talk about practical usage. Imagine a strong upward move. Price rallies aggressively. Eventually, buyers take profits and the market begins to pull back. This is where traders often start looking at Fibonacci levels. Instead of chasing the move higher, they wait for price to retrace into an area of interest. Maybe the 0.5 level. Maybe the 0.618 level. Once price reaches that zone, traders look for confirmation. This is the key step. They don't enter simply because price touched a Fibonacci level. They wait for additional evidence. For example, a bullish candlestick pattern, an RSI bounce, a VWAP reaction, or increasing buying volume. When multiple factors align at the same location, traders refer to this as confluence. And confluence is often much more powerful than any single indicator on its own. A common beginner mistake. This is where many traders get into trouble. They see a 0.618 retracement. They enter immediately. And then they wonder why the trade failed. The reality is simple. Not every Fibonacci level will hold. Markets are dynamic. Some levels work beautifully. Others fail completely. That's why professional traders rarely rely on a single tool. They combine multiple pieces of information before making a decision. Think of Fibonacci as a map. It shows where opportunities may exist, but it doesn't guarantee that an opportunity is actually there. Advanced settings explained. Let's take a quick look at two important settings: deviation and depth. These control how sensitive the indicator is when identifying swing highs and swing lows. If the indicator is drawing too many swings and your chart feels noisy, increase the values. This makes the tool more selective. On the other hand, if the indicator seems slow to recognize recent market moves, try reducing those values. This makes it more responsive. There isn't a universal best setting. The ideal configuration depends on the asset you're trading and the time frame you're using. Bitcoin behaves differently from stocks. Stocks behave differently from Forex. The best approach is simple: experiment. Compare results. And find settings that make sense for your own workflow. Final thoughts. The Auto Fibonacci Retracement tool is one of the easiest ways to start working with Fibonacci levels inside TradingView. It removes much of the guesswork involved in manually selecting swing points. It updates automatically as market structure changes. And it helps you quickly identify potential support and resistance zones. Just remember one thing: the tool is not a trading strategy. It's a decision support tool. Use it alongside other forms of analysis. Look for confirmation. And always manage risk properly. If you do that, this indicator can become a very useful part of your charting process. If you found this tutorial helpful, let me know in the comments. Do you use Fibonacci retracements already? Or is this your first time exploring them? And if you'd like more TradingView tutorials like this one, make sure to subscribe. Thanks for watching, and I'll see you in the next video.